Harish Krishnan, Co-CIO and Head Equity at AB Sun Life AMC. Harish, great to speak with you as always right here on NDTV Profit. And we're speaking with you on an interesting day. I mean, just about 10 sessions to go for the budget. The Trump inauguration is the big focal point. Do you think that we're going to be seeing a bit of guarded trade and maybe instability till things get clearer?
Sure. I think the first 2-3 months is going to be that of what President Trump tweets and how he's reacting, because he's given many contradictory statements in his rhetoric to the elections, to make America great again. Then, of course, there are sanctions on Russia. There is also a talk or a thought process of imposing tariffs. They want lower interest rates. They want a lower currency. So, therefore, there are these contradictory, actions that have won him the election. I think in the next 2-3 months, we'll get to see the axis in which his policy making will take a direction towards. And so our view is that, in the first term of Mr. Trump from 2016, markets took about 2 years to kind of figure out his various policies. In this tenure, we think that the market will kind of figure out in about 6 months or so. And therefore, we think that, this phase of volatility that is getting accompanied by what's happening on the global macro front is something that, we should be looking towards and increasing our allocations and increasing our allocations to various sectors and to equities amidst this volatility that is likely to be there for the course of this quarter at least.
I'm just wondering, Harish, how are you looking at Q3 thus far? You can argue that maybe not enough is there, but fair number of large companies have reported. So far, looking slightly better than Q2 or set for another disappointing quarter?
We do think that earnings support for the markets is quite limited. I mean, we started the year of FY25 with a 16-17% kind of an earnings print, and more likely that we'll close the year with, say, close to about a 10% earnings print. So there has been a series of downgrades. Will we continue to see a downgrade cycle into Q3? Possibly the pace of downgrades, I think, is kind of reducing, but we would still see a reasonably marked deceleration in growth compared to what we had seen in FY24. In Q3 so far, of course, the IT sector and the banking sector, at least the few results that have come through, have been quite okay. But I think the bigger call is that of consumption, which has been on the weak footing. And over there, high frequency indicators like the GST collections don't necessarily give a very inspiring set of numbers that should come through from the consumption side. So I would think that, even over the course of the next 2 quarters, we would see some amount of moderate earnings. Again, how much of it is in the price is the bigger question, because we've seen a reasonable amount of correction across the board. I mean, the median stock in the NSE 500 has fallen by about 25% and more. So there is a certain amount of reset in these expectations that have already been kind of built through. But I still think that, earnings for Q3 and possibly even Q4 are going to be a bit more softer than what expectations are currently today at.
Keeping that in mind, how are you looking at valuations, especially from the broader markets, the mid-cap and the small-cap indices, which, while they have corrected, they have not seen as deep a gash as what one might expect at this point in time. And yet stocks and constituents of these indices still have, as you mentioned, seen very, very sharp corrections.
That's right. So I think it's been heavyweights, doing their work, due to which the indices have fallen a lot lesser. The second is, of course, there's been continual liquidity, both from pooled vehicles like mutual funds, but more importantly, in terms of retail participation into direct equities. We've seen a big shift in a post-COVID world wherein retail investors have lapped onto equities, and from data that's been released by the exchanges, we've seen a massive shift downward in terms of the stocks that they've gone towards, more in terms of, say, micro caps, nano caps, caps and even SME. So possibly that amount of liquidity support is what is kind of holding on as far as these segments are concerned. But when we look from an earnings standpoint, we actually have seen from a 3-year earnings CAGR, actually large caps now having a better deliverance of earnings compared to mid and small cap from a 3 years CAGR point of view. And given our outlook that the next 12 months is also likely to be a bit on the softer side, we don't see a significant support of earnings on the broader markets as well. More specifically, small caps, micro caps typically tend to do a lot better when the economy is on upswing, given the significant lower margin structures that they typically operate on, and therefore every incremental top line growth generally flows through to the bottom line a lot more. So therefore, we think that despite that liquidity support that's currently there, especially from retail investors, our portfolios are more geared towards the larger companies at this point of time, which are leaders in their respective sectors.
All right, Harish, a question then in terms of your constituting your portfolios at the moment. How are you going about weighing, firstly, large caps, mid caps, and small caps at the moment, especially when it comes to your flexi cap portfolios? And going ahead, do you think that there could be more weightage given to large caps given the current circumstances at the moment?
We've been geared towards large caps, over the course of the last year or so. We are almost 77% in large caps, with the rest in mid and small caps in the flexi cap fund. I do think that, over the course of the next 2, 3, 4 months, in this phase of intermittent volatility driven more by global factors, we will actually be increasing the risk. So we would be counter-cyclical. I think there are many companies that have corrected quite significantly. And we do think that this opportunity, which will present itself, we would actually be slightly increasing our exposure towards the towards the breadth of the market. So that's how our positioning from a market cap perspective is in some of our key funds.
All right. Also, in terms of the way we're playing out sectors, and what are your expectations with respect to slightly better prospects in terms of earnings? Or does it come down to not just sectors, but does it come down to stocks now? And will it be a little bit more of a bottom-up approach from here on?
So we think that this year is more likely to be a case of macro than micro. What do I mean by that is that in 23 and 24, we did see, greater reward for stock picking. This time around, especially given the fact that the first half is going to be marred by what Mr. Trump tweets and the global macro developments. And at the second half, we do think that, we're going to likely see a shift in terms of policy making, both from the monetary side, where we've seen a change in the governor, as well as in terms of potentially a greater support from the government in the run-up to the UP elections, which is likely in the next year. I think that, in the second half is where we're going to see a greater focus on earnings and micro stories out there. From a sectoral point of view, the way we look at it is that there are 3 sectors which we term as dark horse sectors, where near-term earnings isn't in the best of shape. Starting out from this list is private banks. We've been underweight the space for almost now 18 to 24 months. When everything was going good for the private banks, they had very good credit growth, they had very strong NIMs and very low credit cost. And yet these stocks got derated primarily because we think that these were supernormal earnings, as these banks gave out a 30-40% earnings growth. Now, as earnings is moderating, I think that the multiples is likely to go up over the course of the next 18-24 months. So private banks, from being underweight, we have now started being a lot more constructive on private banks. The other 2 sectors which are dark horses at this point of time is metals, wherein if you were to look at the profit pool share of metals, you have to go back all the way to 2001 to arrive at today's profit pool share of metals in the top 1,000 companies' profits. We think that the infrastructure push and the investment push push by the government will also influence demand of metal companies. Of course, metals are global cyclicals. In an environment where both US and China are likely stimulating their economies, and in an environment with a depreciating currency bias, I think metals can potentially be a dark horse where there is very little ownership. The third space where we think that there can be a potential kind of a dark horse space could be that of cement. Again, margins have come off very, very sharply. We do think that the overall investment cycle continues to be on an upward trajectory, even as consumption is taking a slightly back seat. And therefore, we think that cement could be under space, and we are moving money from real estate into cement, both of them having reasonably similar drivers. In sectors where there is an earnings momentum at this point of time, and where we continue to have a constructive view, those would include sectors like consumer durables, IT, pharma, and to a certain extent, auto ancillaries and transmission and distribution in the capital goods space.
So IT, you're constructive largely, Harish, with the kind of, I think, pendulum swings of results that we've seen in the major pack?
Right. Do think that AI can be a big opportunity for Indian IT services as it gets mainstreamed with agentic AI, and Indian IT is quite capable of addressing to that opportunity. More importantly, our thesis rests on the fact that, compared to pre-COVID, we've seen a significant amount of offshoring, which has gone up significantly for these Indian IT services. Yet margins are significantly lower than what it was pre-COVID, primarily because of the significant investments that they have done in hiring people when the demand swung very significantly in 2020 and 2021. And these high cost resources are now getting, kind of rationalized over a period of time. And therefore, we do think that margins can potentially move up, along with the potential strength in the US economy. We think that, and with agentic AI, we do think that the overall prospects of the Indian IT continue to remain reasonably favorable. We've been positive on IT for now 18 months, and we continue to have that stance going forward as well.
Okay, well, we'll leave it at that. Thank you so much for joining us here on NDTV Profit.